What just happened to silver? If you woke up this weekend feeling confused, frustrated, maybe even blindsided, you're not alone. The move we just saw caught a lot of people off guard. Price action was sharp, volatility expanded fast, and for a market that had been showing structural strength for months, this felt sudden. So let's slow this down. Before we jump to conclusions, before we assign motives, before we talk about collapse or breakout, we need to understand what actually happened. First, context matters. Silver had been building momentum. It printed consistent higher monthly closes. Gold was setting records. Sentiment had shifted from skepticism to cautious optimism. In that kind of environment, positioning naturally expands. Traders increase leverage. Momentum funds step in. Options activity rises. And when positioning builds, the system becomes sensitive to catalysts. Now, layer in timing. We moved into the end of the week with stretched, short-term technical conditions. Open interest had expanded. Some traders were leaning heavily long. Others were attempting to fade the move. The market was balanced on positioning, not just fundamentals. Then volatility hit. When you see a fast move lower like this, especially into the end of a trading week, the first question is not, is the bull market over? The first question is, was this liquidation? Liquidation looks emotional on a chart, but structurally, it's mechanical. Margin thresholds get triggered, stop losses cascade, options hedges unwind, liquidity thins, price overshoots because orders hit a thinner book. That doesn't necessarily mean the underlying thesis changed, it means leverage was flushed. Another important factor, correlation. Silver does not trade in isolation. When broader risk assets wobble, whether that's equities, crypto, or high-yield credit, silver can get caught in cross-asset deleveraging. If traders need liquidity, they sell what they can, not just what they want. Silver, being liquid and volatile, often becomes part of that equation. So the move we saw may not have been about silver weakness specifically, it may have been about positioning stress across markets. Now let's address what it was not. We did not see a fundamental collapse in industrial demand overnight. We did not see a sudden surge in mine supply. We did not see central banks reversing years of gold accumulation. There was no structural announcement that changed the macro regime. That matters. When structural drivers shift, the narrative changes across weeks and months. When positioning unwinds, it happens fast. This is why Saturday analysis is critical. Weekend reflection allows us to separate structural signals from emotional reactions. Look at the bigger time frame. Even after the recent drop, silver remains elevated relative to where it was months ago. One volatile session does not erase multi-month structure. Markets breathe, they expand and contract. The question is whether they are still making higher lows on meaningful time frames. If this move stabilizes above prior key support levels, then what we witnessed was a flush, not a reversal. Another layer to examine is physical versus paper dynamics. During past sharp declines, one of the key indicators to watch was whether physical premiums collapsed alongside futures prices. If physical demand evaporates, that signals deeper weakness. But if physical buying remains steady while futures experience volatility, that divergence suggests paper-driven movement rather than demand collapse. Weekend reports from dealers and inventory flows will give us more clarity there. We also need to acknowledge psychology. When a market builds momentum, late entrants often join near short-term highs. They are the most sensitive to drawdowns. A fast drop shakes them out first. That reset is painful in the moment, but it often strengthens structure by transferring holdings to stronger hands. Strong hands think in months and years. Weak hands think in hours and days. Right now, the critical question is not whether silver moved sharply. It did. The question is what kind of move it was. Was this a structural top or a leverage reset within a broader trend? Those are very different narratives. History shows that strong markets experience violent pullbacks. In fact, some of the most aggressive bull phases begin with sharp shakeouts that convince the majority that the move is over. But discipline is required here. Blind optimism is just as dangerous as panic. So here is what we need to monitor heading into the new week. First, key support levels on the weekly chart. If silver holds above prior breakout zones, structure remains intact. Second, gold's behavior. If gold remains firm or stable despite silver's volatility, that suggests macro stability rather than systemic breakdown. Third, broader risk markets. If equities and crypto stabilize, then cross-asset liquidation pressure may ease. Fourth, real rates and currency strength. If real yields spike aggressively and the dollar surges, metals can face headwinds. If those metrics remain contained, the macro backdrop may still favor metals longer term. This Saturday is not about predicting a dramatic outcome. It's about clarity. Sharp moves create emotional narratives, but markets operate on positioning, liquidity, and structure. The drop we saw fits the profile of positioning stress more than thesis collapse, at least based on what we know so far. When silver experiences a sharp, fast drop inside a broader uptrend, history gives us a few common patterns to study. Not identical outcomes, markets never repeat perfectly, but structural tendencies. The first pattern is the liquidity vacuum. This happens when price breaks below a short-term technical level and there simply aren't enough resting bids underneath. Stops trigger. Algorithms accelerate. Market makers widen spreads. What looks like panic is often just thin liquidity meeting aggressive selling. These vacuums tend to reverse quickly if the underlying trend is still strong. The second pattern is the margin event. When volatility expands, exchanges sometimes adjust margin requirements. Even rumors of margin adjustments can force traders to reduce exposure preemptively. If leveraged participants are forced to sell, price can overshoot fair value temporarily. What matters is what happens after the margin flush. If buyers step back and once leverage resets, the trend resumes. If buyers disappear, weakness deepens. The third pattern is correlation contagion. If broader markets wobble, especially high beta assets, silver can move in sympathy. It doesn't mean silver's fundamentals changed, it means portfolios were being adjusted under stress. So where does this current move fit? Let's look at behavior, not emotion. The drop was fast but not disorderly across all time frames. We did not see multi-week breakdown confirmation, we saw a rapid expansion of intraday volatility. That suggests positioning stress rather than a multi-month distribution pattern. Another critical signal is volume. Climactic volume spikes during drops can actually mark exhaustion, not continuation. When selling is aggressive but concentrated in a short window, it often reflects forced exits rather than strategic reallocations. Strategic reallocations are slower. They unfold over weeks, they are accompanied by consistent lower highs and fading rebounds. We haven't seen that pattern yet. Now let's zoom out to prior silver cycles. In 2006, 2008, and again in 2010, 2011, silver experienced sharp corrections within broader advances. In many cases, those corrections ranged from 10% to 20% within days or weeks. The difference between continuation and collapse was whether key weekly support held. Weekly structure tells the truth. Daily noise lies. If silver can stabilize above prior breakout zones and form a higher low relative to earlier consolidation areas, then this move becomes a textbook shakeout. If it slices through multiple structural supports and fails to recover, then the conversation changes. But as of now, structure has not definitively broken. Let's also talk about gold's behavior. Silver is more volatile, but gold is the anchor. If gold remains stable or relatively resilient while silver corrects, that often signals that the broader macro thesis remains intact. If gold were collapsing alongside silver, that would imply something more systemic. But isolated silver volatility is historically more common. Now we need to address the emotional side. Drops like this test conviction. They separate traders from investors. Traders operate on short time frames and tight risk parameters. Investors operate on structural narratives and multi-month positioning. Both approaches are valid, but they respond differently to volatility. If you are leveraged, volatility feels existential. If you are unleveraged and positioned strategically, volatility feels uncomfortable but manageable. The market does not reward emotional reactions. It rewards preparation. So what does preparation look like right now? First, clarity on your time horizon. If your thesis for silver is rooted in long-term macro repricing, debt expansion, currency volatility, industrial demand, then one volatile session does not invalidate that thesis. Second, clarity on risk tolerance. If volatility causes sleepless nights, position sizing may be too large. Markets will always test conviction. Third, clarity on signals that would invalidate your view. Every thesis needs an exit condition. Blind optimism is dangerous. Now, let's talk about Monday. Weekend gaps can amplify emotion. If Asia opens weak and extends selling, volatility could expand again. If Asia stabilizes and buyers step in quickly, the flush narrative strengthens. Watch liquidity conditions. Watch early week volume. Watch whether rebounds are sold aggressively or absorbed and built upon. There is another possibility that experienced market participants recognize. Sometimes sharp Friday drops are positioning for the next week's catalyst. Whether that's macro data, central bank commentary, or geopolitical developments, markets often de-risk ahead of uncertainty. If that's the case here, the reaction to the actual catalyst will be revealing. Also consider sentiment resets. Before the drop, short-term sentiment may have been leaning optimistic after months of gains. A fast correction cools sentiment rapidly. That reset can create fuel for the next leg higher if the structural thesis remains intact. Markets climb walls of worry, not ladders of comfort. Right now, worry has returned. That is not automatically bearish. What would be bearish is persistent inability to recover, fading volume on rebounds, and a breakdown in gold's structural strength. We need evidence before assigning narrative. Saturday analysis is about detachment. The chart does not care about our emotions. It reflects flows. At this stage, the evidence points more toward leverage unwinding than systemic breakdown. But the next few sessions will confirm or reject that interpretation. In Part 3, we'll examine macro signals that could either stabilize silver or create additional pressure, including real rates, currency movement, and cross-asset stress indicators, so we can understand what environment we're heading into next week. To understand what may happen next, we need to step away from the chart for a moment and look at the macro signals that typically drive silver in the short to medium term. Start with real rates. Silver, like gold, is sensitive to real interest rates, not just nominal yields, but yields adjusted for inflation expectations. When real rates rise sharply, metals often face pressure because the opportunity cost of holding non-yielding assets increases. When real rates fall or remain contained, metals find support. So the first macro variable to monitor next week is the behavior of real yields. If the recent volatility in silver coincides with a sudden spike in real rates, then pressure could persist. If real rates stabilize or reverse lower, silver may find footing quickly. Next, watch the dollar. A strong dollar often creates headwinds for commodities priced in dollars. If the dollar index broke out sharply into the weekend, that could explain some of the move. But if the dollar's strength fades early next week, the pressure on silver could ease. Currency dynamics matter more than many realize. Silver's volatility is amplified when currency traders reposition aggressively. Now consider bond market stability. When bond yields move rapidly, especially at the long end of the curve, it sends shockwaves through multiple asset classes. Equities adjust, credit spreads widen, liquidity tightens. If the recent silver drop coincided with bond volatility, then silver may have simply been reacting to cross-asset stress. If bond markets calm down, silver may follow. Another factor is equity sentiment. When equity markets correct sharply, especially high beta sectors, investors often reduce exposure across portfolios. Silver can become collateral damage in these de-risking waves, but if equities stabilize or rebound, pressure on silver may ease as risk appetite returns. Correlation matters more during stress events than during stable periods. We also need to consider liquidity conditions. Liquidity tends to thin late in the week. That can exaggerate moves. If liquidity returns early next week and price stabilizes, the Friday flush may look very different in hindsight. But here's the more subtle macro layer. Silver has been moving within a broader narrative of structural repricing. Debt expansion, geopolitical fragmentation, industrial demand growth. None of those structural forces disappear in a single session. However, short-term positioning can temporarily overshadow them. Markets operate on multiple time frames simultaneously. Short-term traders drive volatility. Long-term allocators drive trend. If long-term allocators remain committed, sharp drops become noise inside larger patterns. Now, let's discuss what would shift the narrative more seriously. If next week brings sustained dollar strength, rising real rates, declining gold, and heavy equity selling all at once, then silver could face extended pressure. That would represent a macro tightening environment. But if we see mixed signals, modest dollar stabilization, contained real rates, gold holding firm, then silver's drop likely remains technical rather than structural. Another piece of the puzzle is sentiment extremes. Short-term sentiment can swing from optimism to despair very quickly in silver. If the weekend is filled with panic commentary, aggressive bearish calls, and widespread frustration, that emotional reset can ironically provide the foundation for stabilization. Markets often reverse when emotional extremes peak. However, sentiment alone is not enough. It must align with supportive macro conditions. Let's also examine positioning risk. If leveraged longs were crowded before the drop, the flush may have already cleared that imbalance. Cleaner positioning reduces downside vulnerability. If positioning remains heavy even after the drop, volatility could persist. This is why Monday's early behavior matters so much. We need to observe whether sellers remain aggressive or whether bids step in confidently. Another macro variable is geopolitical tone. Sudden geopolitical headlines can shift commodity flows rapidly. If tensions escalate in ways that impact currency or energy markets, silver may respond indirectly. But absent new structural developments, the broader macro thesis for precious metals remains intact for now. One thing is clear: this was not a slow deterioration. It was a rapid move. Rapid moves are usually positioning driven. The difference between a shakeout and a breakdown is follow-through. If follow-through selling fails to appear, and silver begins forming higher intraday lows early next week, the narrative shifts toward opportunity rather than collapse. If follow-through accelerates and weekly structure cracks decisively, then reassessment becomes necessary. Discipline means being open to both outcomes. Saturday analysis is about removing emotion and mapping scenarios. Scenario 1, liquidity-driven flush, stabilization early next week, resumption of broader uptrend. Scenario 2, macro tightening persists, dollar strengthens, real rates rise, silver tests deeper support. Scenario 3, volatility expands in both directions for several sessions before clarity emerges. Which scenario unfolds will depend less on Friday's emotion and more on next week's macro alignment. At this stage, evidence favors a positioning event rather than systemic breakdown. But markets require confirmation. In the final part, we'll outline a structured framework for how disciplined investors should approach this moment, how to think, how to position, and what signals to respect as clarity returns. So how should disciplined investors approach this moment? First, separate volatility from thesis. A sharp move does not automatically invalidate a structural narrative. Silver has been in a multi-month advance. One aggressive session does not erase broader positioning shifts, industrial demand dynamics, or macro uncertainty. Second, define your time frame clearly. If your exposure is short-term and tactical, respect technical levels. Weekly support matters. Follow-through selling matters. Risk management is not optional. If your exposure is strategic and rooted in longer-term macro themes, then volatility must be contextualized rather than feared. Third, watch confirmation signals. If silver stabilizes early next week, forms higher lows, and gold remains firm, the flush interpretation strengthens. If gold weakens alongside rising real rates and sustained dollar strength, caution becomes warranted. Fourth, avoid emotional extremes. Panic selling at the bottom and blind buying without structure are equally dangerous. Markets reward patience more often than reaction. What just happened to silver may feel dramatic in the moment, but markets breathe. They expand and contract. The critical question is not whether volatility occurred. It is whether structure holds. Right now, the broader structure remains under pressure but not broken. The next few sessions will determine whether this was a necessary reset inside a larger cycle or the beginning of something more defensive. Clarity will come quickly. Until then, discipline is the edge.